Hello, Investify enthusiasts. Today, we're diving into a topic that might just redefine how you view your financial strategy. Get ready, because what we're about to discuss is not only intriguing, but could be crucial for your financial well-being. First up, we have a dire prediction from none other than Robert Kiyosaki, the famed author of Rich Dad, Poor Dad. Kiyosaki, a name synonymous with financial foresight, has sounded an alarm that's echoing through the corridors of the finance world. His message? An upcoming financial crisis targeting the heart of our banking sector. Now, I know what you're thinking. We've heard warnings before. But here's why this one's different. Kiyosaki isn't just any pundit. He's the visionary who saw the 2008 financial crisis coming. When he speaks, it's not just speculation. It's a forecast backed by a track record of accuracy. Kiyosaki's advice in this looming scenario is clear and straightforward. Invest in tangible assets like gold, silver, and yes, the digital gold of our era, Bitcoin. Why these assets? Because they've historically been the bastions of security in tumultuous financial times. They're not just investments, they're your financial lifeboats. But let's pivot to a topic that's closer to home for many of us: consumer credit. Here's a stat that might surprise you. Consumer spending drives a whopping 70% of the US economy. That's a huge number, right? But there's a twist. Delinquency rates in consumer credit are rising, and this isn't just a minor blip on the radar. The reason behind this uptick in delinquency is something you and I face daily: the ever-rising cost of living. From groceries to gas, prices are climbing, but here's the kicker: our salaries aren't keeping up. It's a financial strain that's all too real for many Americans. This imbalance isn't just about more challenging times at the checkout line, it's a domino effect that ripples through our entire economy. When people struggle to pay their credit card bills, their spending power diminishes. And when spending power goes down, the economy feels the pinch. Before we dive deeper, if you're finding this discussion insightful, don't forget to hit that subscribe button. Join our Investify community for more content that keeps you ahead in the financial game. Let's shift our focus now to a less discussed, yet equally alarming issue: the crisis brewing in regional banks. Imagine a small boat in the midst of a raging storm. That's the current scenario for many regional banks. They're navigating through financial challenges that are no less daunting than a tempestuous sea. These institutions, pivotal to local economies, are grappling with a trio of troubles: shrinking profit margins, soaring deposit costs, and declining interest earnings. Each of these factors alone is concerning, but together, they signal a storm on the horizon. But don't just take my word for it. Moody's, a titan in financial services, has been reassessing its outlook on these banks. What does this mean? Potential downgrades. And if history has taught us anything, it's that these signs can't be ignored. Remember the collapse of Wachovia and Washington Mutual back in 2008? They were victims of similar financial distress. Now, let's turn our gaze to the big players: established banks. A shocking revelation from a Federal Reserve report indicates that about 1/3 of all banks harbor hidden vulnerabilities. This is concerning, not just for the banks, but for you and me. Why? Because these issues translate directly to our wallets. The primary culprits behind these vulnerabilities are an over-reliance on wholesale funding and, you guessed it, shrinking profit margins. But there's more. These banks are now compelled to maintain higher reserves, a financial buffer for rainy days. This might sound prudent, but it has a ripple effect on services like mortgages and loans. If you're holding a mortgage or planning to take out a loan, a rocky banking sector could mean higher interest rates hitting your budget. Now, let's talk about a key player in this unfolding drama: the Federal Reserve, often seen as the financial world's firefighter. Robert Kiyosaki, in his usual straightforward manner, has been critical of the Fed's strategies. His skepticism raises a crucial question: can the Fed really douse the flames of an impending financial crisis? The Fed's toolbox includes some powerful tools. One option being discussed is slashing interest rates down to zero. Think of it as trying to cool a scorching economy. Another strategy on the table is quantitative easing, essentially flooding the market with liquidity by purchasing government bonds and other assets. This move could be like an emergency water drop on a raging wildfire. Why does this matter to you? Because the Fed's actions are not just about saving banks, they're about stabilizing the entire financial ecosystem that includes your job, your mortgage, your retirement savings. If the Fed manages to prevent a banking collapse, it's not just saving financial institutions, it's safeguarding the economy that we all rely on. But now, brace yourselves as we unveil a list of banking titans that are currently on shaky ground. These aren't obscure banks in the corner of the financial world. These are major players whose potential downfall could send shockwaves through the economy. Ready for the list? Here it goes. PNC Financial Services Group, SHF Holdings, Citizens Financial Services, Home Street, Western Alliance, ECB Bank Corp., PacWest Bank Corp., First Foundation. Each of these banks, in their own way, is teetering on the edge. From troubling equity losses to concerning debt ratios, the signs are there, clear as day. For instance, SHF Holdings is trading at a mere 51 cents, having lost a staggering 65% of its equity value this year. And that's just the tip of the iceberg. Each bank on this list has its own set of challenges that makes it vulnerable in these turbulent times. As we wrap up our discussion, let's take a closer look at the financial statistics that paint a concerning picture of these banking titans. We're seeing equity values plummeting, with some banks experiencing a decline of up to 77%. High debt loads and poor financial strength are common themes among these institutions. These aren't just numbers on a page, they're warning signs of potential financial turmoil. This brings us to a vital point: the need for a reassessment of our bank choices. In an era where the financial ground is shifting beneath our feet, staying informed and making prudent decisions is more important than ever. So, what can you do to navigate these uncertain waters? Here are some strategies for financial security. Research banks thoroughly. Don't just park your money in any bank. Look into their Moody ratings, delve into their balance sheets. A few hours spent researching could protect your financial future. Opt for FDIC-insured banks. Safety first, right? Banks insured by the Federal Deposit Insurance Corporation, FDIC, offer a safety net for your deposits, even in the event of a bank failure. Consider online banks. Often overlooked, online banks can be a great option. They usually have lower overhead costs, which means you could benefit from higher interest rates and fewer fees. Just ensure they're FDIC insured and have a solid reputation. We've journeyed through a landscape of financial warnings and strategies today. If you found this video helpful, do us a favor, hit that like button. It helps us reach more people with important financial insights. And don't forget to subscribe to Investify for more content that empowers you in your financial journey. We love hearing from you, so drop a comment below with your thoughts or questions. Next up, we've got another must-watch video lined up for you. Stick around, and thanks for joining us on this financial deep dive. Remember, staying informed is your first step towards financial security.